Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
G'day, welcome to the Australian Property Podcast. We're back for 2024 and I'm here with Chris Bates. Batesy, how was your break?
Pete, it's been a good break. It's actually refreshed and I was off for pretty much a month. So 3 weeks in Thailand and a bit of family time over Christmas. So I came back refreshed and recharged, but we've lots coming on this year for us as personally business and been missing these, to be honest. I enjoy these chats every week and can't wait to get going.
Yeah, did you spend a bit of time on the beach over there?
Yeah, we sure did. My poor daughter, she struggles a little bit with her ears. So she's had her adenoids done and her grommets in, and unfortunately she got ear infections for like at least half of the time we couldn't go in the pool. And what do you do in Thailand if you can't go in the pool or the sea? It was a bit of a nightmare, but we did spend lots of time on the beach. The water's almost too warm there in Thailand. You kind of, in Australia, you get that refreshing feeling, but there you're like, it's like a spa. If I was a fish, I wouldn't be living in Thailand, put it that way. Yeah,
we went to Phuket a couple of years ago, actually, and the swim-up bars there in the nice warm sea. Yeah, it's a pretty good place, actually. If I was living as an expat, it wouldn't be a bad option. It's been. I was over in the UK, obviously, for Christmas. I don't think I've ever watched so much Premier League football as I've done over the past few weeks. But with Liverpool top of the league, let's not mention that. Interesting, actually. All the talk in the media this week, it's been a sort of furore about stage 3 tax cuts. And I've got a week in Dubai coming up where there's no personal income tax. So it's kind of interesting. People are sort of debating whether it's fair or not that the 47% tax rate kicks in at 190,000 or 200,000. And I've got a week coming up in a country where there's no personal income tax at all. So I suppose it all depends on your perspective. So that's the politics this week. But we're going to, as we usually do in these 2 cents segments, we're going to look at the big 3 property news stories of the week. I guess actually the tax cuts in a way do factor in to the property market outlook for this year. So we'll probably touch on that a little bit. So Chris, I guess we always try and cover what's topical and what people are writing in about. And it was good to see actually on socials a few people asking when we're back on the air. So, well, here we are. And, these are the 3 property news stories we're going to cover this week. So firstly, BIS Oxford Economics, which I think is going through yet another name change coming up. They've had a few over the years. Property market outlook for 2024, 25 and 26. A few predictions there as reported in the Fin Review. Secondly, another high-profile apartment defect story coming up over the past few weeks, again in New South Wales, in Sydney. So it looks like there may be some resolutions being worked through there. But I guess we'll talk a bit more broadly about what that means for the housing supply challenge and whether or not people will feel sort of able to take the plunge and buy new apartments in that kind of environment. And then thirdly, the fixed rate cliff. We're about 2/3 of the way through that big fixed rate reset. Mortgage arrears haven't really kicked up at all just yet, but we're going to take a look at the outlook for borrowers, particularly in the context of markets pricing interest rate cuts in the second half of the year. We mentioned the stage 3 tax cuts, which will increase borrowing capacity for quite a lot of borrowers. So there's a few things there to chew through, Chris. So let's start with the outlook for 2024. So Nyla Sweeney in the Fin Review did the report on this. The headline was Sydney house prices to increase 16% over the next 3 years, but with units poised to outperform detached homes in the New South Wales capital, with values expected to climb more than 23% as buyers seek cheaper options. That's quite an interesting point, Chris, because I guess in the context of the second story where we've got all these apartment defects, at least for new builds, they're forecasting that actually units will outperform houses on the basis, I guess that's an affordability thing with higher interest rates just pushing people down the price brackets, I suppose.
Yeah, this units versus housing conversation, they like to do these, how much more expensive are houses to apartments? And, if you go back 1, 12, 18 months, that gap was as high as it's ever been from memory in lots of cities because of that COVID push to bigger, more space, and everyone really, the home buy market was in full flight with low interest rates, and that they were going for the housing market, and they're willing to go further away from the city than they have in the past. So because they needed that space with home offices and things like that. And then there was a bit of an argument that, the units would make a comeback. And, while I think in some cities it's slightly cheaper, it's gone back the other way. Units are a little bit more affordable compared to houses in some cities. But in a lot of cities, they're just as, if anything, that gap's just as big, if not bigger now on a dollar value. And so that's been a real big surprise. I mean, I guess with this conversation, units are really hard. You've got the bigger, older apartments. AFR did another article in the last couple of weeks, which I picked up, and it basically showed how the more affluent area in the inner ring suburbs and the performance of those and those apartments in those areas absolutely completely smashed the apartments in, say, high density and things like that. And so the unit market is it's a basket case. It's a box of chocolates, right? And you've got the real premium stuff, and you've got the high density stuff, and you've got the cheap builds for investors, and you've got, the busier roads, and you've got the more, the quieter streets, and the 3 beds and the 2 beds and the 1 beds and the studios, and they're all clunked together. And whereas, detached housing is detached housing, it might be on a busy road, but it hasn't got that variety. And so I would say that the top units perform very similar to houses and have in the past. And, and I think that's what we will see, in the coming years is there's absolutely a pressure on borrowing capacities. And there's also this return to work battle going on. I think part that's employers driving that, obviously, because they've got commercial spaces. They want to get the culture, and they see some type of hybrid models better than 5 days at home. But I also think it's the employees driving that a little bit, having conversations. I think people are more wanting to get back in the office and being with people. And so there's a bit of both, but I don't know whether going back to the 5 days. So I think what that means, though, is if we are in this hybrid model, borrowing capacities are tight, housing prices haven't come down. Well, the only way to bridge that gap is big intergenerational wealth. So I can see that continuing. And I can see there are also some people upgrading from more affluent apartments into the houses because they've got good equity. But I think a lot of people are forced to buy apartments. When I look at their borrowing capacities, the budgets they're looking for those bigger garden apartments, the bigger 2 beds. And so, it's been a big 3 months, Pete, right? Like if we talk about the outlook for 2024, we said it back in November. I know that I've listened to old episodes, so I'm just assuming I said it. But we said it, the market can shift a lot over this 3-month period where there's very little stock. A lot of new data comes out, a lot of news, on inflation and, global inflation, etc. And the story can shift quite a lot. And, you did a great post on your blog yesterday around the interest rate expectations and just how much that's shifted over the last 3 months.
There's definitely that, yeah. I think if you went back 3 months ago, we were looking at interest rates still going up, potentially another hike or two, maybe to peak cash rates of maybe 4.6%. Well, that's been priced out now. And in fact, if you look out over the next 18 months, lower interest rates expected ahead. So I think that was always going to be the thing, right, for buyers, getting some level of confidence that we'd seen the end of the hiking cycle. And it's not 100% locked in yet, but certainly that's what markets are pricing. And in that context, BIS, they predicted Perth is set to outperform 34% price growth for units predicted over 3 years, and house prices 29%. I think that's one thing I can definitely verify. I've got clients over in WA and investors looking over there, and it's just it's going through that cyclical boom that Western Australia definitely can. I guess another sort of anecdote for you, if anecdote's the right word, we've had a couple of clients looking at buying units and apartments in Brisbane. Open homes have been rammed there for the first couple of weeks of the year. So it's normally a pretty quiet time, I guess, in Queensland until Australia Day. But yeah, open homes with 50 groups going through, stuff selling on the first open. And again, I think that's an affordability thing. And I think I've seen enough cycles to know we will see this year the unit prices in Brisbane, having gone for a very long period not doing anything, maybe a dozen years, they're absolutely going to rocket this year. So house prices, well, we'll have to wait and see how the year goes on. But yeah, it's a bit sort of different story around the country, I guess. But I think those are the big macro factors. Interest rates probably will start to fall. CBA thinks from September we'll see the first interest rate cuts. Yes, there's potential that inflation could kick up again, I suppose, with all the conflicts that have flared up around the world, particularly Red Sea, supply chain disruptions. But I guess, market pricing being the best guide here. I think that's probably a key macro factor. And we mentioned the tax cuts as well, which will come effective July. So all that has to work its way through legislation in the meantime. But yeah, I think there's obviously some parts of the country that are forecast to do pretty well. And we don't have to run through all the forecasts. We'll put a link in the show notes there if you want to check out the article. But generally, much more sort of optimistic year ahead than people were looking at maybe a year ago.
And I think this is sentiment is, you got demand and supply and population and new build. There's so many elements into the property market, demographics, migration. You can just keep going on. And that's what I love about the property market. It's so interesting when you look at all these elements. But sentiment and momentum in investment markets, not just property markets, have huge impacts on prices, because prices aren't always just of something that's just based on what it's actually worth. It's what the market feels, and the FOMO and the fear and the desperation and things like that. And I would say that media has a huge part to play in it. We all know the conflicts on who owns who, and who owns domain and real estate, and the passion behind the media just to sell, whether it's fear or positive, and how the property market sells advertising, right? So, but I do think that shifted, right? This article is one, there's another art, they're always, I think that negative article is not really there so much. It's all about a bit more positive on where things are going, and people buy into that. And I think what we're seeing is we're not seeing an avalanche of new buyers come to us. I would say it's just probably in the middle, right? We're seeing definitely January's where it had been much more frenzy and FOMO. But we're also seeing much quieter Januaries. If you go back 12 months, it was much quieter than it is this January, right? And there is this perception of trying to get in before rate cuts. And that's kind of front that, it's kind of like buyers are trying to get ahead of the herd. Well, actually, you know what? You're just part of the herd, because the herd's already, you're one of the herd. And so I do think there's that expectation. I do think this rental crisis is going to continue. Everything's just pointing that there's not going to be all these investors entering the market. And so your rental crisis is still going to be there. People are still going to want to buy, and they're worried if they don't buy now, even if they don't, they would want something a bit bigger and a bit more expensive, and something that would suit them longer term. They're worried that if they wait for borrowing capacities or wait for higher income or a price falls, it's not going to happen. So they've got to get into the market now. And so people are basically buying what their budgets can afford. And that does put more pressure on the sort of a bit lower, the price points and the unit market, particularly in the capital cities. But when you say, Pete, that they were really busy opens, I imagine you're going to, a real low rise. It's probably an apartment in New Farm or
Cooperoo. Not the big high rise towers. Yeah, that's
exactly.
Right. That is true.
And so that's the family market or the couple market. Going, okay, we want to buy something, we want some security, we want to get some money to work for us, and we could live here for 5 or 10 years, and it's where we ultimately would love a home. We can't afford a home, but we can get a great apartment in those areas. And so you are going to, and the irony with unit prices, when they go up, that also gives a higher chance for supply to come on, because what developers can't do right now is sell them because they can't make profit. If unit prices go up, that then makes the feasibility study, particularly building prices, plateau, or the confidence around prices continues, and labor, then that will be a whole off-the-plan boom will come. And so we actually do need unit prices to go up for the development industry to build. But once that happens, then the development industries will push go, right? They've been land banking. They've got the sites ready to go. They just need the numbers to stack up.
Well, that's more or less our second story on the apartment supply challenge. So just to wrap up on that first story, BIS. Interesting. I've spoken to a couple of people in Melbourne, and they say actually things are relatively quiet so far. I mean, it's early days in the year, and they also did highlight the potential question mark around the longevity, I suppose, of the boom in Adelaide with shifts in interstate migration in the context of a very strong run there for housing prices. So yeah, Chris, second story, apartment defects. So I'm just quoting here from The Guardian. Almost 1,000 recently completed apartments in Sydney's north are at risk of collapsing due to serious damage to concrete in the basements caused by defective workmanship, according to the New South Wales builder watchdog. So the developer there was Greenland, so not a local developer. And this is Macquarie Park for context there. So serious damage. Now, look, this could well be resolved in time, but I suppose, I'm more so interested, Chris, in the macro impacts of this rather than the specific 900 units or the 4 tower blocks in question. And those issues may well be remedied, but there's a bigger or wider reputational risk here. And, what does that mean for off-the-plan sales? We know that there's a big housing supply challenge anyway, as you mentioned. The most recent quarterly figures showed housing starts dropping by 10% to 37,000. So that's the lowest quarter since 2012. And that's at a time when we've got record high population growth. In Queensland, the government seems to have got into the habit of buying existing properties to sort of fill in for social housing or homelessness rather than actually building anything. So the social housing supply is frozen up, really. It's not increasing. And you mentioned there's a lot of cost pressures as well for developers. So it's a bit of a cocktail, a bit of a mess, really, for getting that new apartment supply to come on. You mentioned the building costs. Well, Cordell said construction costs are only up 3% in 2023. So they're coming down, but they're not coming down, if that makes sense. They're just going up less quickly. So housing starts at decade lows at a time when we've got population growth running at over 600,000. And the last thing we need is these high-profile stories about risk of unit blocks collapsing, because that's not going to encourage people to buy off the plan.
Yeah, I think you could look at it that way and say, we do need to try to solve this. We need more supply, right? But these articles are true stories, right? Like, these are actual people who have got huge problems. And I think if I go back all the way to 2015, I was banging on getting abuse online when I'd write something negative towards off the plan and building issues. And no, you can make so much money and off the plan, all the developers and spruikers would come attack me. But the truth is, we were seeing the results, right? We were seeing the performance of our clients who had bought, off the plan. We were seeing the results around defects. We were, seeing how that really had a huge impact in their future financially by making a poor investment decision where they're an investor. And they've had huge losses sometimes, particularly in apartments in Melbourne and Brisbane. We had clients with hundreds of thousands of dollars under. So I think the building issue thing is now widespread. Okay, so the cat's out of the bag, and it's, the pigeons are flying around. I guess what developers have to do is you just have to prove your quality right now, and you just have to deliver quality, right? So you have to oversell the quality. You have to basically go back and, it's really hard for new builders who haven't got the track record, right? But if you are a builder that's got great quality and you can back yourself and your past projects are that, then you'd be trying to give as much transparency to buyers as you can, and really selling it on your quality. If that's your, competitive advantage, which you have to have a competitive advantage in building, because that's what someone's buying, right? So I just think it's lifted the standards in the building game, and that probably also lifts prices, and so you can't have both. You can't have, people trying to undercut each other and to provide a cheaper and cheaper apartments, and then think that quality is not going to get affected, particularly some of these builders that are, developers going to a builder and saying, hey, I'm going to put you in a bit of a tender and a bidding war between 3 other builders. And they all undercut each other, and then they run their margins so tight, then weather, material, developers had a horrible time in the last few years. And then that job becomes a loss-making job. And, they want to get it out fast, and corners get missed and things don't get. So I would it is an issue. It's one of the risks of buying new property. You don't know what you're buying until it's been built. And then even when it's been built, problems don't start to come up straight away. Water issues start coming months, years down the line. By then it's too late. And it's one of the reasons why we're massive fans of the established market over the new market.
It's interesting you mentioned people chirping you online, but it's not really just an opinion. It's statistically a fact. CoreLogic have done the work on this, and they show that when you look at loss on resale, it's statistically much more likely that somebody buying an off-the-plan property is going to make a loss on resale than somebody who buys established. And that's kind of logical when you think about it, because you do generally pay a price premium to buy brand new. And of course, 3 or 4 years down the track or 10 years down the track, the property is no longer new. And there is going to be some depreciation there, and that's, I guess, partly reflected in the tax code and the depreciation benefits that you do get for buying new properties. I think there's kind of two different risks that you touched on there, Chris. I mean, firstly, there's like this issue with Greenland, Australia. Yes, the cost of rectifying the damage, but then some buyers might fall through the cracks. But the other thing is insolvency. There's just so many insolvencies actually happening. And then there's the different legal situation for creditors, for people who put down a deposit. There's all these kind of things where you might, in good faith, buy an off-the-plan apartment, and then something happens and the developer at the moment, we've got insolvencies at decade high. So there's those risks as well. I think, I suppose, just a third thing to throw into the mix, and that is when we saw the previous construction boom. So I'm thinking 2015, 2016, when all of those tower blocks were coming out of the ground to really catch up for very high population growth. That's when we started to get all the defects. We had Mascot Towers, we had Opal Towers, there was a couple of other high-profile developments. And I think we've got the same challenge now, is that there's this massive push to build 1.2 million homes in 5 years, and we're off to a very poor start, it should be said. But it's when you're trying to rush through projects at warp speed, well, that's when the defects are more likely to happen. So I think the commissioners really need to do some work here. Skill shortages is one thing, but also just giving people the confidence that if defects come about, then, well, people need to know that the commissioner is going to deal with legacy defects and not just leave you high and dry with some kind of, some kind of debt or remedy cost that you can't cover.
I mean, it's one of the big issues that, you buy something that's even not off the plan but reasonably built. You think you're fine, you think you're covered by warranty, but a little bit of digging, you'll realize there's no warranty, right? The strata, the building defects, particularly after a builder's period, and it varies state to state, etc. But you just got to be really careful that and I think buyers are left high and dry. You get more protection buying a toaster than you do buying an apartment, and that hasn't really changed too much. And I think the building commissioner in New South Wales appointed for those reasons. And so I just think this is going to be a story. I think if we come back in 2034, Pete, and we're still doing 2 cents, which I hope we are, we'll still be talking about building defects. And I think it's just a problem that exists. But that doesn't, and ultimately that generally means that you shouldn't be buying this stuff. There's better options out there, and buy something where you've got a higher chance of certainty of not something going wrong. So what are we going to go for story 3, Pete?
You mentioned, the types of stuff that we do generally look to buy for units, boutique blocks. The ones I mentioned in the past week or two, places like Coorparoo in Brisbane, low-rise, boutique developments, quiet streets. But also there's a whole range of things you look for in an established unit. And we generally steer clear of the big high-rise towers with pools and gyms and high strata fees and who knows what, coming down the track in terms of strata issues. So let's move on. Third and final story. Let's look at the mortgage market. So firstly, the fixed rate cliff has mostly passed by with a bit of a whimper in the end. There wasn't really much to write home about. But then also in the second half of the year, we've got stage 3 tax cuts. We've got interest rates expected to fall. So S&P Global put out the latest mortgage arrears figures. Well, for 30-day arrears, they've actually fallen, interestingly. So they're still below 1%. There are some areas of rising arrears, generally for the more indebted borrowers, so the high LVR loans. But about 2/3 of those fixed rate loans that we saw written at those ultra low mortgage rates, well, they've already now reset, and there's still some more to come. I think so far it's causing a bit of a slowdown or maybe even a recession in retail spending as people cut back on their discretionary expenditure, but it hasn't really led to any housing market fallout just yet. I think the reason why arrears are falling, Chris, is that if you think back over the past decade, the problem child states have usually been Western Australia, where there was a resources downturn, and Queensland, where there was a bit of that, but also flooding. But those states are both booming, and actually arrears are falling in both those areas. There are some rising arrears in parts of New South Wales and Victoria, but I would say that's probably expected with interest rates going up. But overall, well, overall borrowers have dealt with it pretty well. And I know you've said previously that most of the people on your mortgage books have dealt with the reset pretty easily.
Yeah, we haven't had any issues. I mean, I think it's reminds me of the 2019, 20 or something like that, the interest only cliff. They love these cliffs.
Whenever it was.
Yeah. I wonder what the next cliff's going to be. But yeah, and it's a great story you can build on it. The property bears love it, right? They get the data. The Taras Bookers, our good friend Martin North, they love these, these stories because they perpetuate. They're easy to add other elements on and confirmation bias. And, what they sometimes forget is the behavioral. What will happen, though, when things get tough, right? Will they sell their home or will they not? And you can see with listing numbers. I generally think, there's always this excitement in this time of year that there's going to be this boom in listings. The media will always pick if there's an early trend that listings are a little bit higher than long-term averages, even though they only use averages the last 5 years, not long-term, to be honest. I think their listings will stay really, really dry over the next 6 months. We're going to be complaining like we have been complaining for the last 5 years that there's not enough good properties on the market. And so that's the issue with these type of stories is they kind of forget that there's people in homes and people don't just make rash decisions in property markets like they maybe do in stock markets a little bit. They can dump their stock. They know they can get back in and they haven't got to rent something in the middle. And so that story has played out. I thought, I do think that people have made cutbacks. I actually thought there'd probably be more people going to banks. I've been surprised with how people have been as resilient as they are because no one expected rates to go up over 4 basis points, 4% in 12 months or whatever it was, right? That was a huge increase. No one was really factoring that into their budgets, particularly out there around that 6% mark. That was like the worst case. A lot of people were factoring in rates are at that rates now. So, but I think there's been a lot of intergenerational money coming down to help kids buy property. But I think there's just as much coming down to help people stay in their properties. And I think parents are helping their kids with mortgages. The kids are making cutbacks. Real rates stayed really low. And I think the banks have probably been a bit surprised too that the amount of people are calling up for payment holidays is really low as well. Now, if rates stay high for 2 or 3 more years, I don't think people can last that long, right? But there's this light at the end of the tunnel now that rates are going to start getting cut. I think the amount of income growth over the last few years, particularly for the people who borrowed the most money, the people who borrowed a lot of money were the people who were confident financially, right? The people who really stretched. And a lot of them have actually got wage increases over the last few years. And so while wage increases may not have been across the board that big, for the people who borrowed a lot of money, they probably had wage increases because the ones who borrowed the money had the confidence or were feeling positive around their short-term income prospects. You don't go into a lot of debt thinking you're going to lose your job in 6 months' time or you're not going to get that bonus. You be more conservative. And so I think that's what's played out as well is the people with a lot of debt have had quite big increases in salaries. And then I also think the people who have really struggled is there's been a bit of money coming down the line to top up their mortgage repayments.
People do love those fixed rate cliff or interest only cliff. And there was even going back a decade ago, the fiscal cliff. There was, I think people just love to say, I've seen this movie before. I've seen The Big Short. We had all those ninja loans resetting and then that's going to happen again. But I think it's what James Whelan christened the theory of thing. When everybody's talking about something like this and there's headlines in the Fin Review or the Australian or the ABC Business News, well, it very rarely plays out like that because everybody knows what the risks are. Solutions are found. Usually risks are, I find the bigger risks are things that completely broadside people, like a pandemic or, who knows what. It's not the things that people are talking about for months and months on end because, yes, there'll be some forced sellers in the housing market, but as you said, there'll be plenty of people keen to buy as well to get out of the rental market. So it's not as clear cut as, if X happens, then Y is the result. And it's the same in stock markets too. You see people making very confident predictions and then a year or two down the track, they can end up looking pretty stupid because things go in a different direction altogether. Chris, let's wrap up with the stage 3 tax cuts. It's been in the news all week. It's doing my head in. So I guess if you haven't been following this, where should we start? Well, the previous government, the coalition, had legislated tax cuts and particularly These being the stage 3 tax cuts, as the name suggests. So it's not the first part of the legislation, but there were significant tax cuts, particularly for the highest income earners expected. Now, there's been various amounts of pressure on the Labour government to do things differently. So to summarise, the 45% marginal rate will now kick in from $190,000. So it was $180,000 previously. The coalition had actually legislated $200,000. So there's a few higher income earners not too happy about that. So they'll still get a tax cut of about $4,500, but it's not the $9,000 they were hoping for. But there's another side to this, and that is that people earning up to 150K will get a bigger tax cut. So I guess you could certainly argue that it's fairer in that sense, because I think those households are the people who've been most hit by, I guess, rising food prices, childcare, insurance, energy costs. So I think from that perspective, I think it's considered a progressive move. And I think certainly maybe from a monetary policy perspective, this won't pour as much inflation fuel on the fire, so to speak. So I guess it would be good in terms of tackling inflation and bringing interest rates down. But, I suppose this all depends on your perspective. I think the top rate kicked in at 180,000 way back in 2008. And I guess if it had been indexed to inflation all the way since that time, then the top rate would be about 260K. So look, anyway, in terms of what this means for the housing market, well, a couple of things. Firstly, I think 2-income households up to 150K will get a nice little boost to their income and their borrowing capacities from July. I think top rate taxpayers will be a little bit annoyed. They'll still get a 4.5K tax cut, but they'll be looking for ways to reduce their tax payable, and obviously negatively geared property is always a popular thing in Australia. There's a political impact to all of this as well. But I think it's more, Chris, if you get the combination of tax cuts plus falling interest rates, that's when you get a bit of sizzle in the sausage, and then that could actually fire up housing a little bit as a result.
Yeah, I mean, we spoke about this a couple of times last year. It's kind of off the radar, right? It's 2024, it's not happening. Then bang, January comes, and like you say, it's on the front pages, and 11th hour, guess what? We're going to make some changes to it. Even though it's we're not going to make changes. We're not going to make changes. So typical politics. But ultimately, I mean, I think it's a bit of money in people's pockets, right, when they need it most. We are going through, particularly people with mortgages, right, and cost of living pressure. Whether you take less money off the upper end, whether that affects inflation, I reckon their savings rate's higher, right? So and particularly now when the mortgages are really high, I don't think they're going to rush out and spend that money, particularly at the higher the bucket. They're probably going to pay off their mortgages or invest. And whereas if you give more money to the medium and lower taxpayers, I think more likely that money's going to get spent. And so I don't know how it affects inflation. I think less tax cuts probably a good thing at the moment for stimulating any inflation, I would say. But I think people need it. So it's a bit of a catch-22. Whether it's a big thing for the property market, it does make a small difference to borrowing capacities, I would say. And I do think it helps people feel a little bit more confident around their decisions if they know they're going to have to pay less tax and they're going to have more cash flow, particularly if wage increases are going to come. So I'm going to have more of that wage increase in my pocket because the tax rates are lower. And so... yeah, I don't think it affects borrowing capacity too much, but I think what really, like you say, it's like back if you look at 2019, Labor liked to win the election, then bang, they lost. Negative gearing wasn't going to go. Capital gains tax wasn't going to get increased. And then there was APRA stepped in, massive rate cuts, and then bang, the property market took off because they had all these ingredients, and demand increased dramatically when supply was low. So I think supply is going to stay low. And if we start to increase demand with tax cuts, rate cuts, borrowing capacity going up, still a rental crisis, and then we start to see a FOMO come into the market, which we could very easily see. I mean, there's a front page of the AFR now. Yesterday, Sydney house prices at all-time new highs, right? What happens if in 6 months' time we say that the market surprised everyone, it's gone up another 5-10%, and then there's this FOMO kicking in, right? And so... yeah, I think tax cuts are just one of the fingers in this conversation, and but it's going to get a lot of media talk over the next few weeks, and but it's just really a watering down, right? It's not like they're not going to happen at all.
It's a point you've made before, Chris, and that is, I think sometimes Australia is almost a victim of our own success. I think, with the budgets going roaring back into a surplus, so, people saying, well, we can't afford the tax cuts. It's a little bit like, well, yes, there's a structural element and a cyclical element, but, being a Brit, I see the headlines over the past week or two, the government's net debt to GDP ratio in the UK is 100%. It's back to where it was in the early 1960s. What's the US, 120, something like that? Well, Australia's net debt's going to drift down 25, 20. We've got no kind of issue compared to some of these European countries or other parts of the world. And we're so mineral rich and resources rich. We've got coal, natural gas, iron ore, copper, gold, silver. We've got everything in Australia. There's loads of people want to come and move here. I think almost because of that, as you mentioned, we end up with record high house prices. I think the big challenge at the moment is just the housing supply. Those targets are drifting ever further away. And there's going to be some political pressures. I think that's the thing. Yes, we can argue about whether 45% tax rates are too high, whatever it is. But what people are really interested in from an equality perspective is how do we get that housing supply moving in a fair way? Because at the moment, 37,000 dwelling starts and virtually no social housing being built on a net basis anyway. At a time when we're running population growth at over 600,000, that's a problem. And I guess that those are big challenges. And as you said, we'll probably still be talking about that at the end of the decade, the way things are going. So, yeah, lots happening. So I guess those are the big three stories this week, Chris. So we've covered the property market outlook for 2024, apartment defects back in the media, and also the housing supply challenge. And then, yes, interesting stuff happening as the year rolls on, tax cuts, interest rate cuts, changes to borrowing capacity. So definitely a good time to speak to a mortgage broker, I guess, Chris, you're going to say.
Yeah, absolutely. I'm just sort of reflecting on a different article I saw where the parents are buying an apartment for their kids. We've started to see this again. So I think, 2023, a lot of people have thought, my kids are really struggling to rent, or I've got a 6-year-old, which was a client yesterday. I'm actually really worried. We're going to stay in Sydney long term. I'm actually really worried where they're going to live and are they going to be able to get in. And so they prioritize their own dreams, but now they're like, actually, I want to get something that's they can use for a housing deposit or they live in. And that has come up in previous booms before, where they basically buy within the capital city they're living in because they don't want their kids to live in a different state. And so I wonder if we're going to see this, investors, home buyers buying for their kids, and that would be another thing that pushes up usually the unit market in our capital cities. So I think that's a thing to watch. But absolutely, get in contact in the show notes. There's a link there. All our team's back in action. We're doing a massive merger in the next few weeks. So I can give you some more details on that in a few 2 cents time. But absolutely, we'd love to help.
Sadly, not a problem I've ever had to deal with, parents buying me a unit in the capital city, but maybe in the next life I'll get some different wealthier parents. But I'm not going to lie, we've got a unit in New Farm in Brisbane. I've already said to the kids, like, if I was you, I'd be going to uni in Brisbane, go to UQ or somewhere, and you can jag somewhere to live, but probably shouldn't put those ideas in their heads. But likewise, if you're interested in buying a property this year, Brisbane or New South Wales, Southeast Queensland, we're pretty busy. So drop us a line. Always happy to have a chat at Alan Wargent. So, Chris, there's going to be stacks to talk about this year. So we should wrap it up there for this week, but always looking forward to our chats. And have a great weekend.
You too. Happy Sunday, everyone. Good to be back.